chop, all my young homie. All my young homie, chop, 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 all my young homie. Chop, 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 chop.
What is up, guys? We are live, and I am so excited for today's call. We have one of our friends is going to be stopping by. He's got some questions on how to utilize the ultimate creative finance calculator. It's really, I've made it the ultimate real estate investing calculator out there for traditional, for cash, for subject to, for seller finance, for hybrid, for DSCR loans. Like, it literally can help you analyze every single acquisition strategy as well as management strategies. On there, we got pad split or co-living, my favorite, short-term rentals, mid-term rentals, and long-term rentals. And so I'll be showing you guys through that today as we help him out. So Mark will be hopping in shortly. And then I have a bunch of questions that you guys have been asking me all throughout the week. So got a bunch of questions I'll be answering for you guys. What are some of the traditional financing methods I use to buy real estate? How am I buying real estate using none of my own money? Do I have co-living rentals outside of pad split markets? If so, how do I choose them? How do I know where to go? And why do I prefer co-living in pad split markets versus self-managing my co-living rentals? I'll be going over as much of that as possible today. Obviously, it's a lot of topics in 1 hour, but I'm here to help you guys out as much as I can. As a reminder, I'm Michael Manatskanian. I'm a real estate investor who started learning 7 years ago, bought my first property 5 years ago, and I currently own over $20 million of real estate, and I purchased basically all of that using little to none of my own money. So I raise money to buy my deals. I provide my capital partners great investment returns, and we all win-win together, which is awesome. And I have my free Wealth Through Real Estate school community, free trainings, free tools and resources like a calculator, checklists, all these things that you need to be able to help you on your investing journey, as well as my super investors. It's a paid mastermind community, primarily for real estate investors who feel stuck or are ready to take things to the next level. You maybe are doing deals traditionally. You want to start incorporating creative financing. You are buying properties using your own money. You want to leverage other people's money so that you can scale your portfolio. Maybe you're only doing long-term rentals, but you know you want much more cash flow and wealth benefits through co-living or even short-term rental and short-term rental or mid-term rentals. So let me get Mark the link real fast. So we're going to invite a guest, copy that. I'm going to send to him, and then we are going to start with some live streams. So let's get it. All right, just got him in, or he's going to be hopping in right now. So with that, let's see some of the questions that are asked. Let's start with the first one. Let me pull it up right here so I can look at you guys. Look at those beautiful faces. All right. What are some of the traditional financing methods that I use to buy real estate? I love this question because I think people completely miss the mark when they think of me, when they think of super investors. Super investors, I have the super investor cheat code. Very simply, it is the most efficient path to financial freedom through real estate investing. That's the most accessible deals, the easiest way to get into them, easiest way to raise money for them with the maximum amount of returns, right? And the super investor cheat code is quite literally buy deals creatively financed. You do not have to be a wholesaler to get great creatively financed deals. I show you exactly how to do so. How to fund those deals using none of your own money. And maybe you do put in some money, but it's a lot less than the typical $70,000 to $130,000 you have to put in. You're going to raise the majority of that. And then maximize all of your cash flow and your ownership benefits through the co-living model, right? That's a super investor cheat code, but that's not the only strategy there is when it comes to being a super investor. It's understanding what are the different ways to buy deals. Like I mentioned, sometimes it makes sense to go cash. Maybe you get a hard money lender and you get a private money lender to fill in the gap, and then you buy that deal and then you refinance it like the Burr method. Sometimes you're going to buy a property outright through a DSCR loan, right? Debt service coverage ratio loan. I've used both those strategies. I've used conventional loans to house hack small multifamily properties. I've used a VA loan, an FHA loan, a 5% down conventional loan. I've gone those routes. Sometimes the majority of my deals are creatively financed. I buy properties subject to, which means I'm buying the property, but the seller's debt stays in place, right? So They bought the property a couple years ago and they have 2, 3, 4% interest rates. I'm buying the properties. I'm the owner. However, the debt stays in place, which means I take over that great interest rate, subject to seller finance. Sometimes the seller has a lot of equity and I structure a deal with them directly without any banks involved, or hybrid, which is the combination of subject to and seller finance. Sometimes I combine traditional loans with seller finance so that I'm buying properties using little to none amount of money, or I get paid up front, aka the Morby method. The idea of being a super investor is having various tools in your tool belt to acquire deals, not just one and only one strategy. It's building through getting really knowledgeable of the different strategies, how to analyze those deals, and then choosing which one makes the most sense for that property, for that specific situation. So the traditional methods I've used to buy real estate, well, I just hit them on the head. I've bought properties cash. I've bought properties using low down payment, owner occupied loans, VA loan as a veteran, FHA loan, 3.5% down payment option, 5% down conventional loans. And I've used those to buy 2 to 4 unit properties, live in one unit, rent out the others. I also use DSCR loans, which are, think of it just a traditional loan, but it's instead of them focusing on who you are as the individual, they're more focused on how the property is going to perform. And that's how they fund those deals. So basically, you find a great cash flowing rental, they will fund a solid piece of that. Like there's usually 20 to 30% down payment, and that loan will fund the rest. Then it's up to you. Are you going to fund the 20 to 30% down payment yourself? You're going to raise money for that. But those are the traditional methods that I use to buy real estate. That actually is really important because when we get into the calculator, I'll show you how you're able to analyze those various situations with Mark right now. And then the next question we'll be answering is, how am I buying real estate using none of my own money? We're going to do that after we get on the calculator with Mark. So let me pull Mark up here. I want him to explain what's going on, and then we are going to screen share, and I'm going to show you some cool stuff. So I'm going to get Mark up. What's up, Mark? How you doing, brother?
Hey, I'm doing good, man.
Awesome, awesome. So can you give me a quick heads up? Actually, I'm going to go into screen share mode, and then I want you to fill in the gaps for me. So I'm going to go to here. So Mark is part of the Wealth Through Real Estate School community. Mark asked a great question. He purchased the Ultimate Creative Finance Calculator, now just kind of the ultimate real estate investing calculator. And his question was right here. So if you're not familiar with Wealth Through Real Estate, it is my free, absolutely free community. Anyone is welcome to join it. You just go on school.com/wealth-rei. Go on my Instagram. Let's see. Instagram at Michael MNAT. Go to the link in my bio. It's there for you. I got free webinars coming up this month, 4 free trainings. I had a cool YouTube video I put up yesterday in honor of my 31st birthday, 31 lessons in 31 years. And then a bunch of things, free calculators, free tools, and the free Wealth Through Real Estate community is right here. You want to ask me questions because so many people are constantly asking me questions. I want to make sure I provide as much value as possible. To do that, that's what the free school community is. There's 1,300 members in this community, and I'm trying to help as many of you guys as possible. Mark did the right thing. He went in, he posted a question, and here's this question, the calculator question. I have some help. I need some help with this question, and he tagged it as Q&A. So he went in, put in his question, select category, Q&A. So then I know, hey, he needs help with this question, and let's look at it. So basically, you're buying a property. There's no existing mortgage. Explain the rest to me, because I actually got a little confused with your question, but I said, let's just do it live to help other people out who have that question. And just to help everyone else.
Yeah.
Just to
I watched the
sorry, Mark,
I watched the
real
video that explained everything, and it just didn't have the circumstance that I'm trying to do. So the property has no mortgage on it, right? It was a probate deal.
Mm-hmm.
The lady's asking for cash. I'm going to use a private money lender that's going to bring all of the money for the deal. So the money's going to be split up into the purchase price and then the cost of rehab.
And are you flipping it?
No, we're going to turn it into co-living.
Okay, cool. This is easy. So what you've explained to me very simply is this is a cash deal and you are funding it through a private money lender, right? That is
Correct.
why it's so advantageous to have the super creative finance calculator, like the total one that has everything in it, not just the free one, because this will actually answer both how to acquire it, what the returns look like, how to analyze it, but also if you bring in a capital partner to fund the deal, what that looks like as well. So just for everyone who doesn't know, you can get a copy of my free creative finance calculator. It's in Wealth to Real Estate, just to show you guys real fast. And you can grab a copy. It's like all over. Well, like just grab the free creative finance calculator. Like I'm going to clean these up, but it's just here. You can grab a free copy of the calculator. I got tons of them. You go to this, you go to the resources. It's here as well. So there's plenty of places where you can grab a copy. Okay. And so let's get into it. Let's get into the main one because this is the one you're working on.
Yeah. So,
What are you
Michael, the challenge with this comes in because the money that's being borrowed is going to be an interest-only loan, and there's I don't think that's an interest-only calculator where you put in the seller finance loan, because I think you just use the seller finance spot
No,
to
I'll clarify now that I understand. You're buying this property basically cash. Well, you're buying this property cash. You're paying her outright, but then you need to understand what are your returns look like for your private money lender. That's when you go to the other people money tab in the bottom. When you're going to look at your private money lender analysis, what does this deal look like when it's funded, when the acquisition is funded by a private money lender? How much are you paying them in interest? And then what are your returns after you're paying them? So all you have to do for cash, just to show you guys real fast, let me zoom in. We're not going to go into the weeds of this calc. I got plenty of videos on that. What I'm going to show you is when you're deciding how you're going to purchase, whether it's a hybrid creative deal, right, subject to seller finance, just subject to deal, just the seller finance deal, traditional or DSCR loans, or cash, all you have to do is you said it's a $200,000 purchase price, right? You're buying it for $200,000.
Well, that's what she's asking. I hope to get her down around 190, but
whatever.
let's just use
But for the sake of this example, $200,000, right, is what you're doing. You're buying it for $200,000. Because it's a cash deal, you're paying that $200,000 all up front. There's no loan in place, right? $200,000 purchase, it's cash. You're paying her $200,000, right? Okay. Yep. And then we're going to look at the other entry costs. We're going to look at, you're going to have, is there an agent involved?
Nope.
Nope. So that's zero. There's going to be some closing costs. I'm assuming, is she covering it out of her 200? Or are you covering it? Are you splitting?
Yeah, let's just say I'm covering it.
Let's stick with the 2% for now and then you'll get more clarity. There are some additional closing costs. I separate them as admin / reimbursement fees. If you're paying for a transaction coordinator to set up an LLC, inspection, it's going to cost money. I separate that from closing costs because I usually pay that in advance, and then it gets reimbursed by my capital partner at closing. So I just separate those two.
Yeah, but we're not going to have any of that. My wife's a TC, and I already have the LLC. It's been in place.
Perfect. So we'll set. You're going to do an inspection or no?
Nope.
All right, there you go, $0. And then how much do you estimate you're going to renovate the property?
Well,
I just need a number. It doesn't have to be, we're not going to analyze the full deal. I just want to show you how you can use this.
Let's go with 40K.
40K.
Yep.
No wholesaler involved. This is direct?
Direct.
Cool. And then you're going to have a few months of reserves, whatever. It's going to be very minimal because there's no mortgage reserves, right?
Right.
All right. So you have your entry cost is $247,540. You're buying this $200,000 property, and then you're putting in an additional $47,540 to cover rehab, closing costs, carrying costs, all that good stuff. So now
I was going to add in 5K of reserves just to have that.
Yeah, we have 3540. We can add 5K. You just override it. Perfect.
All right.
Now you're going to need to analyze this deal, right? You have the acquisition. There's no mortgage or anything. You just need to look at, let's zoom out a little bit. You said you're going to do a co-living rental. So this is a little confusing, guys. I'll explain why it's really not. You can analyze for long-term rental just the same way you can analyze for cash, traditional DSCR loans, seller finance subject to and hybrid as acquisitions. You can also analyze as a long-term rental, co-living or pad split property, which is a rent by the room, midterm rental, and short-term rental. We're going to just skip right to co-living since you said that's the one you want to do. What you're going to do here is then analyze this thing as a co-living rental. So how? Depending on like if that 40K already accounts for the additional bedrooms and all that stuff, you can just not add anything here. Just set these to 0. Does that account for the 40K already for the bedrooms? Cool. Are you furnishing the property?
Yep.
All right. So we're going to, how many current rooms are there and how many are you adding?
There's 3 and we're going to add 3.
Okay, perfect. So there's 3 here and you're adding 3 more. My rough rule of thumb is for the total number of bedrooms, multiply that by 1,500. That's the cost to furnish the property for co-living. Each room is closer to $800 to $1,200 a month. However, that additional cost is also going to cover furnishing common areas. Kitchen, if you have a living room, outdoor space. Obviously, the more common shared spaces you have, the more you're going to have to furnish, the less, basically. So your total entry with the furnishing is now $258,000. We're not going to get into the weeds on this video, this training, because we have a bunch of questions to answer. But you're going to need to set how many private bathrooms and how many shared bathrooms there are in the property, right? How many of the rooms have a private bathroom versus shared, and just make sure that this,
Yep, 2 and 4. There you go.
Perfect. 2 and 4. You're gonna have to set your weekly rates, right? Like, what are you charging weekly? And then your expenses. Your fixed expenses are going to be very low, right? All you're going to have to account for are taxes and insurance. I assume no HOA.
No HOA.
Perfect. So your fixed expenses, because there's no debt, is taxes and insurance.
Right. $3,054 for taxes.
What was that?
$3,054 for taxes and $1,800 for insurance.
Perfect. And that is the co-living insurance, or that's just a just standard insurance estimate?
That I jacked it up a little bit. It was about $1,200 for regular insurance, so I went to $1,800.
Perfect. Yeah, so that's what I do here. So like you do it for like your regular strategy, and then I just add extra buffer here. You've already done that for because if you're renting by the room or short-term rental, even as a landlord, you're going to pay more than just a homeowner would pay. You've already accounted for that up above. Then, depending on your property, you're going to need to put your various expenses. I'm just going to assume all this is correct. For the sake of this, you're going to plug and play with this later. Depending on if you're self-managing, you have other property manager, wherever market you're choosing, what the vacancy and maintenance of CapEx is. For this example, I'm going to disregard how accurate the expenses are. This example, assuming the income and expenses are correct, your income is $4,420 a month. Your expenses are $1,135 plus management plus reserves. You are cash flowing $1,900 a month on this property, but you have such a high initial entry because of the cash that the cash on cash return isn't extremely high. For me, I don't like this example. However, what you need to see is this doesn't account for your cash flow when you're paying your private money lender. And that's where this other people money tab is. So if you were to use your own funds, that's what this is saying. Use your own $258,000 to buy this property. This is what your returns would be. However, if you were to use a private money partner, someone comes in, they fund the deal, you found the deal and you operate it. Let's just say it's a 50-50 split. They pay the $258,000, you guys split the ownership down the middle, 50-50. Your returns are, in that sense, infinite, because you put in no money and you're getting cash flow. You're getting almost $11,500 a year of cash flow. Your returns are infinite, and also so is your return on investment, because you put in no money. Everything, as long as it's positive, is infinite. For them, for their $258,000 investment, their cash on cash return is 4.5%, and their return on investment is 8.3%. If you were to go a private money lender, instead of having someone come in and split ownership, if you were to go with a private money lender, this is your scenario that you've expressed. You pay them 12% interest, no fees or origination points, 12-month loan, right? In 12 months, you have to either, or you can do 36, whatever makes sense for you and your lender. you're going to pay them $15,480 of interest. If you're paying them a 12% interest on their $258,000, you are going to be losing $665 a month. Why? Because your private money lender payment is $2,580. Your return on this property is $1,915 in cash flow. So your interest to your lender is $600 more, roughly, than what or $665 more than the cash flow generating on this property. So infinite returns don't work if you're paying more in debt, right? Yep. On your debt, your interest, than the actual profits of the property. And not only are you going to lose $665 a month in cash flow, almost $8,000 a year, you also have to pay them back this $258,000 when you're doing the when you do the refinance, right? Whether it's 12 months, whenever the exit of your PML is. So the other option is to go give them equity, someone who's interested in equity in this scenario, and then they'll hold the property with you longer. They also get ownership benefits and all that good stuff. Maybe it works, maybe it doesn't. But what I will tell you, this is when you go this route, it's great that you're considering raising money from someone else to fund this deal. But when you go straight cash, most deals don't make sense as a long-term rental, because virtually no matter how much you get in cash flow, that much of an entry just defeats your cash on cash return. You can do a lot more with that money. Real estate is at its maximum advantage when you are leveraging. So even if you went with a traditional loan and had a loan in there, let's say you put 25% down, and instead of raising $258,000, you put 25% down. They still get their money up front. Let's say it's a 8% interest, right? 7 to 8% is what you might see right now. Even though you're going to be paying $1,100 a month on that loan, let's see, because your entry is now went from $250 to $99, but then you also have the additional $9,000. So your entry went from like $258 to $108. You've cut that entry in more than half. Let's see how your cash flow holds. So your cash flow is over $1,000 a month less, which makes sense because you are now paying $1,100 of that to the loan, right?
Mm-hmm.
Your cash flow is significantly lower, but actually your cash on cash return is higher. It's still not the numbers that I like to see, but it is substantially higher. That's usually the advantage that you see with real estate. And now with a fraction, less than half the entry, you are able to take ownership of the same property with way less entry, which is the way you scale in real estate. Less money you put in to get on each deal, the better it is. So usually the better it is. And let's see what that looks like in this scenario. So because they put way less in, even though the cash on cash return is virtually the same for them, there's a smaller piece of the pie. There's less cash flow to split, but they're also putting significantly less in. Your cash on cash return is roughly the same, but because you put in less to get ownership of the same asset, the return on investment is much higher, right? If you were to split that 50-50. This was I believe, less than 10% last time. Mm-hmm. It still does not work with a private money lender because you are paying 12% to a private money lender on $108,000. You're paying 8% on the $150,000 or whatever it was for the debt service loan. It just doesn't make a lot of sense because there's so much high interest debt. This is why I tell everyone my super investor cheat code really prioritizes creative financing. Why? Because if this was seller financing, it may not work for the seller. They want all their money. But if this was seller financing, let's change this to seller financing. Instead of, let's say you do a 10% down, and let's say they're open to 5% interest rate. All right, what's that look like? What does that look like now? So you're paying less in monthly, even though your loan amount is higher because you're putting less down payment, your loan amount is higher. You're paying less each month because your interest rate is lower. And your overall entry has been cut by $30K. So now you only need $78,000 to get in. You're paying less monthly. Now this property is generating $949 of monthly cash flow, and the cash on cash return is 14.6%, much closer to the terms that I like. And this is not a very unreasonable creative financing option. to offer 5% seller finance, 10% down, you can get a lot of deals structured that way. In this instance, now your private money partner that you split 50-50, they're getting a 7.3% cash on cash return, over 3% higher than last time. Their return on investment is way higher because your guys' entry is so much lower. And it still may, okay, so it does just barely work with a private money lender. You would keep all of your ownership with a private money lender. So for you, you'd get all the ownership benefits, but you'd be giving up the majority of your cash flow. You'd be making $2,000 a month in cash flow. Whereas even if you split 50-50, you'd be making $5,700 a month in cash flow. So I'm just trying to show you the various ways. This is why I tell people it's so imperative to understand the various ways to acquire and the trade-offs. The problem with cash is the money still has to come from somewhere. So you're better off at least getting a new traditional loan. But because the interest rate is so high, it's probably going to defeat a lot of your returns. The one thing I want to caveat to everyone watching, these numbers we put in here, the income, I don't know where this property is. I don't know what the income is. These are just placeholder numbers. I don't know what the expenses are outside of the debt that we're playing around with. But assuming those are fixed, I just kind of showed you why I prefer creative, why you can make more deals work that way. Because especially if it's seller financing, you can say, hey, what if I was to, instead of paying you $200,000, I paid you $220,000. Your down payment goes up a little bit, but now we're doing a 2.5% seller finance loan. You can play around with these things. Well, you cannot do that with a bank. The advantage here massively is now you can say, hey, I'm giving you a higher purchase price. I'm baking in your interest where I would not be able to do that. That's why it's a lower monthly payment on interest. This, I'm assuming this is one of my favorite strategies, increase purchase price by a little bit, reduce either the down payment or reduce the interest rate. And let's see how this deal in this scenario looks. Now we're talking about $1,100 a month of cash flow, 16.9% cash on cash return. You split that with a private money partner 50-50. Now you're not raising $250,000, which I don't know about your experience, Mark, but I've raised hundreds of thousands of dollars, $750,000 in 3 days, but it took years to build up to that. On average, I'm raising $60,000 to $130,000 per deal. It's a lot of money for a deal. Even $80,000 is a lot of money for a deal to raise through an individual. So this is phenomenal returns. This would be very viable for someone who wants to partner with you. Even if you went the private money lender route and gave up, you're keeping the majority of the owner, you're keeping all the ownership, you're giving up the majority of the cash flow to a private money lender, you'd still be getting infinite returns because at least now you're positive. This is why, guys, there's a spectrum. Cash, traditional, creative. And I always prefer creative, not only because it's more scalable, I can buy much more of those deals. However, I can also get much better terms, especially on the seller financing, because everything is negotiable. It's you're in direct contact with the seller.
Yep.
And you can work with them and say, hey, I want to buy this, but it does not make sense for me to buy it. Well, you could do, yeah, exactly. So Caleb Christopher mentioned something that's a combination of the two. The Morby method, essentially. He said offering 25% equity, 50% of cash flow on this. Oh, no. So Caleb Christopher is raising money for a deal right now. That's what he's talking about. But you can do something called the Morby method. You can do a traditional loan plus have a component of seller financing. So let's say the seller, like, why does the seller need the money? Like, what do they need it? What do they need $200,000 for today? They say that's the only way we'll be able to, we'll sell it.
Yeah, I don't know. She hasn't really divulged that. I think she's just, I don't know. She's elderly. She's 62. And
most 62-year-olds, it's an assumption. Most 62-year-olds don't know what to do with $200,000, but they do like monthly payments to cover their expenses. And they don't want to pay the taxes on $200,000.
Right.
Your number one way to go creative is to understand the seller truly. What are they looking to accomplish? If they had a magic wand, what is it they want? What is it they truly, well, sometimes it's what do they need, right? It's not even what they want. What do you need? This person has a lot of equity, I would assume. They own it out, like you mentioned. So they're going to kick tires and wait for the best offer or whatever. You need to understand if they had a magic wand, what are they hoping to accomplish? That's how you go creative and pitch it. You're going to have to do your full analysis, but I hope this explained the various ways you can analyze it, and to everyone watching, why I love creative financing over methods, over cash and traditional. Not to say I don't buy that way, but it's not my favorite strategy. Another option would be you buy it traditionally. I mean, you buy it cash, through a hard money lender, private money lender, whatever. Then you refinance the property, pull some, if not all of your original investment out. And now you are doing the Burr method. You're buying it, you're renovating it, you're renting it out, and then you're refinancing it, pulling your money out. That's how you're going to get that 258 you put in or whatever you put in out as quickly as possible. So then you have very little invested in the deal and you have equity in the property. I do a lot of that as well, but it just depends on your acquisition strategy that you're trying to do and what you're trying to accomplish here.
Yeah, I have to just win her over with seller finance. She's dead set against it, and it's a little more complicated. It's an inherited property. She owns 50%, and then her two nephews own 25% each. And they're battling. I got this deal because my closing attorney, told me about it because he's the boys' attorney. Mm-hmm. Because she's not selling fast enough. It's been 2.5 years, and they've wanted to close the trust out, and she's just not moving. And she just has said, because that's the very first thing I approached her with was seller finance or partial seller finance. And she said, I'll have nothing to do with any of that.
Yeah. And honestly, if it's a probate scenario, like you said, right? So then there's multiple people involved. A lot of times creative doesn't work well in that because then you have to not just understand what is one person needs. You have to understand what everyone else needs, and it all has to be congruent, which is usually not the case because they're younger. They're going to probably just want the money and to move on. Most people in probate situation just want to move on, as opposed to like a tired landlord who likes the monthly income but doesn't want to deal with the work. Those are my favorite type of seller finance deals, is the tired landlord, absentee landlords, people who owned it. They made their money. Now they want to cash out, get that mailbox money with little to no work now. They're the most conducive towards seller financing options through my personal experience. Doesn't mean they always have the best terms for me, so it may not work, but they're the ones who understand it and translate really well towards that.
Right.
So, but I just hope I painted the picture of how to use the calculator and what the various benefits of going creative versus traditional are. Any more questions on this topic? Because we can spend all day on.
Yeah. No, I just the new download on the calculator is coming out how soon? Because this is a little different.
It's out. It's out right now. You go in, it's there. It's the new, you click the thing, it's already on there. So this is the newest version of the Super Creative Finance Calculator. This is what it is now. So this is the calculator. The free one's out there as well. Whoever wants it, remember, you're not going to be able to analyze like buying these things, these properties using other people's money. It doesn't have the long-term analysis. It doesn't have key features. It doesn't have private money lender. So like this is a cheat code for my super investors, right? And people who have this calculator, you can screenshot just this and put it in your marketing to say very clearly, here's the returns for you. This is what you're going to get. Your money is this is the total amount. This is how much is going towards acquisitions, to renovations, to reserves. Here's the structure of the deal that we're buying. Here is your returns 1, 5, and 10-year snapshot by just analyzing. Everything else is automated for you. This is the ultimate cheat code. I mean, I had to build this thing because no one else had this. And now I share it with other people. Super investors always get access to this. And then people like Mark who are purchasing the calculator are more than welcome to do that as well. But, it's a lot easier when you're part of the super investors community. Cool, brother?
Yeah. So that you don't have to change any of the numbers down on the other calculator that shows private money lender, private money partner, except for the interest rate, right? That's the only thing you would change.
All you have to change here is what are you offering? Like Caleb said in his example, he's doing 25% equity or ownership, 50% cash flow, and that's all you have to say, or 50-50, or whatever the situation is. Let's say you're giving your private money partner, say you're doing 60%, whatever it is, that's all you change. Every single thing else is automated. For the private money lender side, it's okay, well, what's the rate that they're paying? Is it 10%? Is it, I don't know what I just did. Like you just change that. And then you change if there's any points in the loan terms. That's all you have to change. But more often than not for these real estate investments is 12%. So I kind of just preset the most common things. A 12-month loan, no origination fee, 12% interest rate for these buy and hold type deals.
Now, is that an interest only?
This is interest only. This is interest only. This is if it's actually principal and interest. Now you're just basically creating a new mortgage. But understand, you have, like, if you're doing that, you're paying so much towards principal and interest, you're going to virtually have no deals that make sense that way. Same reason why you're going to have cash flow, a lot of cash flow on a cash deal, because you're buying it up front. There's no monthly payment, but the entry cost is so high, you're financing on that entry at 10, 12 higher percent is going to destroy all your returns. Same concept here. If you're having principal and interest payments, even if it's at a 6%, it's pretty much going to eat away all of your freaking cash flow. It's like, what's the point of buying that property? Especially going through a PML, where that's where I almost always recommend people to go the private money partnership route, because even though you're giving ownership up of your property, you guys are splitting ownership. First of all, it's easier to raise funds that way. Secondarily, you're keeping more of your cash flow than you would with it. Even if you're giving them 60%, you're making $5,400 of cash flow here, where here you're making less than 4,000. You're giving up 50% of your cash flow, 50% of your ownership, but you're keeping more of the cash flow even in that scenario, because the 12% interest rate is a larger payment. And for me, if for everyone starting out, especially, if your goal is to be financially free, you do that through generating as much cash flow as possible. Even though you're giving up some of your ownership, your wealth benefits in the long term, you're keeping more of your cash flow. Get yourself $5,000, $10,000, $20,000 a month of cash flow, then worry about keeping 100% of your ownership benefits, things like that. Because your ownership benefits are not going to pay your bills. They'll make you wealthy in the long term. You'll be able to pull out money in the future, but what it's not going to do is pay you monthly to then be able to live off your investment portfolio. You do that through maximizing your cash flow. You do that through maximizing income through co-living. You do that through maximizing your income and minimizing your expenses through creative financing. You do that by being as scalable as possible through leveraging other people's money. You throw in the cheat code of private money partnership instead of private money lenders. Now we're talking about really keeping, on average, we're getting $1,500 to $2,000 a month in cash flow per property, fully financed. And then we're splitting that 70-30, 60-40, 50-50 with our partners. We're keeping anywhere between $500 to $1,000 a month in cash flow. Stack a couple of these guys up. Very easy, very scalable, very specific, tangible path to financial freedom.
Right.
Cool, brother. Yeah. I'm dropping you off. All right. Thank you, Mark.
All right. Thanks, brother. Appreciate it.
Of course. All right. So with that, the question that came up was, how am I buying real estate using none of my own money? Well, this is how I just explained to you. I have private money partners or private money lenders that are funding my entry cost. Even if, there's always going to be some form of debt, right? There's going to be, it's either creatively financed, it's either traditionally financed, it's or cash. I'm not really a huge cash guy, honestly, unless it's to do the Burr method, or I know I'm going to increase the value and then I'm going to sell it real quickly. But for long-term buy and holds, it's hybrid, some variation of creative financing, or traditional. And then my capital partners are funding these entry costs. They're the ones funding down payments. If there's any arrears or liens on the property, you have to pay off at closing, agent commissions, closing costs, rehab and furnishing costs. If there's an assignment fee to pay a wholesaler, acquisition fees, and then reserves for the property. They're paying for that. And either in exchange, I'm giving them ownership and cash flow of our properties through private money partners, right? They're not just lending me money. They're lending money. They're paying money to buy their ownership in this investment. Their money they're contributing is buying them ownership of this investment. It's up to you, ultimately, you and your partner, what percentage they get. So my private money partners, they pay money, they cover all the entry costs. In this example, $80,400. And now they're a, let's say, 50-50 owner of this investment. These are their returns. My returns are infinite, right? My return on cash flow, my cash on cash return, which is the cash flow divided by my entry. I have no money in the deal. My returns are infinite. My return on investment, which also accounts for appreciation, the debt pay down benefits. So these are equity benefits, the tax benefits through interest payments and appreciation, my cash flow benefits, all of that together, the $20,375 I'm making each year on this property. When I put no money in, my returns are infinite. They're putting the money in, they're getting 50% of the benefits. These are their returns. This is how I'm buying real estate using none of my own money. I'm combining existing debt or new debt plus capital partners, private money lenders, private money partners to then buy these properties. If I'm going the private money lender route, this is truly a loan. They are lending me a fixed dollar amount for a fixed interest rate, and I'm paying them back their interest in fixed intervals, and I'm paying them all their money they gave me at a fixed end date. Very common is they're lending me, let's say, $80,000 at a 12% interest rate for 12 months. So I'm paying them biannually. So let's say twice a year, or let's go quarterly. I'm paying them quarterly $2,400 a month of interest in every quarter for a year. And then at the very end, I'm paying them their $80,400 back. And I'm doing so by either selling the property, refinancing the loan, or refinancing my lender by replacing them with someone else, especially after the property's already stabilized. That's why I'm buying real estate using my own money. Hopefully that is as clear as I can make it with some actual values there. All right, so another great question. And for anyone asking questions, I apologize if I don't see them right now. Oh, lots of questions. Okay, I will get to these later. Yes, the Letterman sisters. Oh, hey, Ronnie. 62 is not elderly. She's absolutely right. It's not elderly. I just mean some people at that point who have owned their assets outright, what they're trying to do is they just want that mailbox money. They've worked hard for a while. They've built this asset. They've owned it for a long time. They've gotten a lot of the active benefits of it. Now they just want the passive benefits of it. They want the monthly payments without any of the work anymore. And that's what seller financing can solve for them. All right, next question. Do I have co-living rentals outside of pad split markets? If so, how do I choose and where? Perfect question. So if you go to the free Wealth to Real Estate school community, you go to classroom and you go to bird dogging, I literally show you what is pad split. You can sign up for free for a pad split account. Pad split is the equivalent of what Airbnb is for short-term rentals, is what pad split is for co-living or rent by the room. They're basically the main number one place where you get your tenants, where you find tenants that for your rent by the room properties in the markets that they operate in. They also handle like tenant communications, like on their platform. People can book to stay at your property through there. Your members can book to stay in your property through there. They collect all the payments and then pay you out. They do all of that stuff. You still have to manage just like you would a short-term rental, right? You still have to send over the contractors, help them move in, help them move out, all that stuff. But they're this platform that allows you to make it as easy as possible to find tenants, communicate with them, and then collect income and pay them out. And another awesome benefit is once you have your free account, once again, all this is in Wealth to Real Estate. Once you have your account, you can leverage their host tools so you can see amazing things like what markets are they operating in? What investments are they providing here? So that you guys ask me, co-living rentals outside of pad split markets. Well, I do have some co-living rentals outside of pad split markets. However, my favorite way to buy properties is in pad split markets. Why? Because I already know they've invested a ton of time, money, and energy to determine which markets make the most sense for them to grow and scale and invest their money in and operate in. This is something known as like the Starbucks effect or the Whole Foods effect or whatever. Like a lot of people assume a good market, a good area is where there's a Whole Foods or a Starbucks. Why? Because they have millions and billions of dollars and they're investing millions, tens of millions, hundreds of millions of dollars to determine where should they own and operate their businesses. I'm not any smarter than all those guys and all their money. And same here, they're investing, their pathway is choosing where they're going to open up shop. Why would I try to create the trend where I can follow where they've already invested a lot of time and energy into? For example, I own in Atlanta, I own in a lot of pad split markets, but I also own in non-pad split markets, primarily because this map didn't always look like this. When I started in 2023, there were a lot less markets than there currently are. The blue markets are their core markets. These are their already established markets. Gray are their emerging markets. It's insane to see how many markets are on here, how many markets are they growing and scaling into. That was not even the case before, and how many are already core markets for them, these blue markets. When I started out, I don't even remember much more than Atlanta, Tampa. Like it was very minimal where they were operating at that point. So where do I own outside of pad split markets? Well, some of them are markets that were not pad split markets that now are. Some of them, like Savannah, Georgia, that we own in, me and several other partners, Savannah right here is not a pad split market, but we do rent by the room in that market. Works solid. There's Florida markets that were not part of their, in this Cape Coral area, that were not part of their core markets when we started. And at this point, we've gotten really good at that. There's no point of transitioning over to pad split. We're already operating that sufficiently without. Own in, where are we at? Where's Tennessee? So own in Clarksville, Tennessee, and now it's a starting market for them, but they don't have anything here yet. They have very little here right now. Well, we might convert that property to co-living or on the pad split platform to help get more tenants on that property. However, it's not a core focus of ours right now. Like, so there are markets that are not pad split markets that I'm investing in, but to the majority of people starting out or scaling, the advice I can give you is make your job as easy as possible. Operate in markets that already make sense. How do you know? Pad split. Pad split, especially now with the wealth of data they share. But how do I know where to choose? Well, I choose based on what makes sense. I did a whole masterclass. If you want access to this masterclass, reach out, like post in my free school community, comment on this video. Let me know that you want access to this masterclass that I did on how I'm choosing very specific markets that make a lot of sense. But what it really is, what it breaks down into, let's see. I might actually be able to pull it up real fast, just give you guys a little preview. Let me go to the perfect. And I, once again, in this, I reference pad split. All right. Hopefully y'all can see. Let me hide this. How to choose co-living markets. Focus on markets like the market on affordability, right? Is this an expensive market that people have been priced out of being able to live there, or they're giving up the majority of their income, 30+%, 50+% of their income to paying for that studio or one bedroom apartment? Is this market conducive towards the need for affordable housing? Are there a lot of salaries, $60K and less? That's less than $5,000 a month of income. And then after taxes, it's even less than that. And the average one bedroom or studio was like $1,100 or more, right? Is this a market that needs more affordable housing? And how do you compare that? What are the current studio and one bedroom rents in that area? Are there a lot of salaries under 60K? Operate in big markets. There might be a lot of places where there's low salaries, but there's also really low rental income or really low rental costs. That may not be a great market, or the market is really small, so there's a lot less people that would be looking for that. So operate in larger markets that have like just any major city. I mean, pad split, like I show here, pad split's the cheat code. They're telling you where. They're showing you where there's a need for it and where they're focusing on. And they not only just tell you that, they also tell you how many units are there for co-living? How many are upcoming? What's the demand? How many people have searched in the last 30 days? Well, Atlanta, their core market, the market they started in, has under 10,000 active units. And even though people think, oh, it's saturated, it's just too many, whatever, it's not even the case. In the last 30 days alone, almost 40,000 people searched for the less than 10,000 active units that are available. There's a reason why the property we just put up in Atlanta got rented out completely in less than 30 days. There were a ton of people searching, but you have to have a good property. It says here on the occupancy, on average, how many of these rooms are occupied? How quickly do your first booking happen? How about 80% occupancy? Once again, our numbers are significantly higher because we see the average, we see the competition, we make our properties better than that. Remember, average is 50%. You should be above average. Your goal is to be above average. How do you do that? Have your properties be in better areas, look nicer, better photographs, amenities at minimum at the average, if not more so. And you'll realize real quickly as you search other properties in the market, you will see that it doesn't take a lot to beat average. You may not be in the top 5%, but it's not very hard to beat average because it feels like half the people are taking photos with Nokia brick phones. Like, I don't know what's going on, why they take such terrible photos, why they make it so much harder for them to be landlords. But you've seen plenty of rental listings all over, whether it's long-term or whatever, where people are they're their own worst enemy. And that's for them to figure out. Or I'll buy their property creatively financed in the future when they can't make it work. So that being said, this is it. Market on affordability, but just make your life easier. Focus on pad split markets. There's so many out there right now. It's amazing to see. And then I like primarily, if I'm in a non-passive market, you'll see a trend here. When I go to Savannah, Georgia, near a military base. Clarksville, near a military base, right? I like, as a veteran, as someone who started out in my local market of Fairbanks, Alaska, military community, transient community, not the biggest population, around 30K people. However, I know that people are constantly coming in and out. Healthcare workers, very, very common demographic that needs this. Airline employees, military personnel, they're cool with living off base, saving money by sharing a shared common space, by having their own room, but now they get to keep the majority of their basic housing allowance as opposed to it being fully taken away if they lived on base. So it's ultimately up to you. That's some strategies. For me, I like pad split markets. So I pretty much answered both. How do I choose? And why do I for co-living and pad split markets for self-managing? Well, they're doing all the hard work for me. They're telling me what markets make sense. Could I go on Zillow? You can go on Zillow now and search for rent by the room. You can go on Zillow right now. Whoops. So we can go on Zillow and you can do for rent. And now you can do, you can check it out by the room. That's how popularized this is. This did not used to be the case. I don't even think a year ago. You can see in a market, what are the rent by the room? What is going on here? This is one way to find out. Is there a healthy amount of rent by the room? What are they priced at, right? Like, how quickly are they going? This is one of the strategies. For super investors, we have like a dozen different places you can list and find this stuff. But for the majority, Zillow, check out Redfin, Furnish Finder. That's a platform for midterm rentals. Airbnb has rent by the room as well. You can rent a property out by the room. These are all platforms that we use to rent properties out when it's not on pad split and where we can get some good data. So if you want to understand the core, obviously pad split. If you're going off pad split, Zillow, Zillow, apartments.com, Redfin, like these traditional type of rental platforms, Airbnb, Furnish Finder. Those are kind of the core three of what you should be looking at if you're trying to find this without using pad split data. Once again, I don't think it's the best strategy. I think it's better to go through through pad split if you're doing co-living. Why? Because it's going to take you more time and energy and increase your risk to go off the pad split platform. And you and your team might not be ready for that. You may not have the skill set yet or the reserve set aside to be able to handle the higher risk of non-pad split markets. You may not have the knowledge yet to be able to make that work, where some people crush it. Just understand that that's more work. And for me, my job is not to maximize my, an extra $200 of rental income on one property. My job is to pay that to free up my time, let's say to a pad split, free up my time and not worry, like minimize the amount of time it takes to rent out a property, but leverage that time to then raise more money so I can buy more deals using none of my own money, so then I can continue to get infinite returns. Thousands, instead of focusing on how I can maximize an extra $200 of cash flow on this one property, I want to go buy another property that'll add another $7,000 a month or $7,000 a year of cash flow, several $100s a month, right? It's over 500 plus in this example. It's again, fake numbers, right? Mine is 750 plus typically. I'd rather, raise money and find more great deals so I can then buy more properties that are generating me solid cash flow using none of my own money. I'm building my portfolio. I'm adding more cash flow using none of my own money. I'm adding more ownership benefits using none of my own money. I am building more financial freedom, more cash flow, and building more wealth through the ownership benefits. That to me is a better use of my time. That is a better source of leverage than trying to maximize my cash flow by self-managing an asset, because that is then taking away my ability to scale my portfolio. Does that make sense? Everything in this world is a trade-off. Everyone has only so much time. I'm going to be breaking all of this down in detail starting tomorrow, June 12th. I'm doing 4 free webinars, literally for anyone and everyone. Let's see. All you have to do is go on my Instagram, in my link tree. It's there. Live free trainings. I have 4 free webinars for you guys. I'm literally going to show you how I went and scaled my portfolio from $2 million to $22 million in less than 3 years without killing myself or using my own money. You can register for all these. Number one, path to financial freedom. I'm showing you exactly my path. I'm helping you determine your financial freedom number so then you can develop your own path and understand the financial freedom components, the ownership and wealth benefits of it, and how you can maximize that using the super investor cheat code. Then the next training is all on super co-living deal analysis. You want to be super, you want to maximize your returns, cash flow, and ownership benefits. Co-living is the number one strategy to do so right now. Most accessible, highest returns, best properties in the best markets. And it also makes it easier to raise money when your deals are better and you're doing a investment strategy that provides affordable housing and more people are interested in learning. So I'm breaking that down all for you guys, how to analyze deals and then how co-living takes it to the next level, why I believe it is better on every single level than any long-term rental, short-term rental, or mid-term rental. Next part of the training, finding great deals and capital partners. You want to consistently find great deals, want to find capital partners and buy deals using none of your own money. That's what this training is focused on. You want the super investor cheat code. All of this is freaking put on steroids, doing super investor activities, focusing on that higher leverage, the things that I wish I knew 3 years ago when I was scaling my portfolio, and I had to learn the harder and slower way. Well, I got that for you. And all you got to do is register one time and you'll get access to all 4 of these and the recordings, right? And if you want, you get access to my calculator and all these other things for you, but this is how you are going to take it to the next level. The majority of this will be all value for you guys. I'm going to give you the breakdown right now. I'm going to present my super investor community. I'm opening the doors once again to super investors. We have not done that since November of last year. We're opening the doors to super investors who are interested in joining. However, that is not even the focus of these trainings. That is 5%. Am I going to be talking about super investors? 95% of this is going to be focused on you getting tangible value, actual things you can learn and implement in your business, regardless of your experience, regardless of your knowledge, so you can scale. Super investors is not for everyone. The few that make sense for, I'll see you in super investors. The majority of you, I want you guys to watch these trainings, learn, and just get so much value from it and take your investing to the next level. Leverage all the free tools and resources that I provide you. I'm here to help you guys out. If super investors make sense for you, awesome. Go for it. Join. I'd love to see you in there. I'd love to see you in our super investors community if you're the right fit. But nonetheless, register for the webinar. Take advantage of all the free benefits that I provide. I'm here to help you guys. All right. Best luck on your journey. Hope you guys have an excellent day. If you want a lot of value, connect with me on Instagram, connect with me on YouTube, connect with me in my free Wealth to Real Estate community. Show up for these office hours, ask your questions. Let me help you guys provide as much value as I possibly can. And then if you're ready to take this to the next level, maybe you're stuck, you don't know how to scale, you don't know how to use other people's money, you don't know how to leverage creative financing, you don't even know what co-living is or how to implement it in your business, other things like that, you need my tools and resources, the calculator, the free CRM I provide to you in the community, absolutely free, so you can raise money, make that a breeze for you on my templates and resources. That's super investors. You know if you're in that position, if it makes sense for you. If you're ready to invest in that, reach out to me. Let's get on a call. Just DM me on Instagram. Let's just get connected. With that, guys, appreciate you. Have a phenomenal rest of your day, and we will do more trainings. I'll see you all next week. Actually, no, next week, I'm canceling next week. I'm doing 4 webinars in the next basically 8 days. That's more than enough value. So we're going to cancel next week's office hours. We're going to do all of these trainings in the webinars. And for my super investors, I will see you tonight for another phenomenal session that we have. We have an amazing guest coach coming in. All right, guys, appreciate you. And I hope y'all have a phenomenal rest of your day.
All my young